All right, everyone. Today we've got someone special who's been around this game long enough to see it evolve from the Wild West days to where the future's heading in the non QM world, of course. John Wise, EVP of Sales, National Production at Newfi Lending, is in studio with us today, and we're talking non QM. What's real? What's hype? And how is it shaping broker success right now? Welcome, John.
Thank you, KT. It's great to be with you, my friend.
Yeah, it was great seeing you last week at
Yeah,
Fuse. What an event we had, and we got some good takeaways to make it even better for next
yeah,
year.
no
Um,
question.
so what I'd like to do is just really jump in, and I'd like to get to know our guest a little bit and who we're talking to. So, what information can you give me about John Wise? Just a quick overview of your role at Newfi and what your day to day looks like, and let the audience know who you are.
Absolutely. No, I appreciate it. It's great to be with you, KT. And it was a great event, great town. It's the first time I'd ever been to Nashville. So I really enjoyed getting to know Nashville a little bit and seeing all the brokers from AIME and loved the event. So, a little bit about me. I've been in the business for 37 years. So a long time. I've seen the mortgage business evolve, different states with good times, bad times. Really, some of the toughest times to originate loans, I think, are today, right now, right here today. It's a challenge for loan officers, and that's why we love sharing information to help them close more loans. Everybody needs to close one more loan these days, and we're here to help do that. So here at Newfi's been in business for about a decade, little over a decade. And in my role here, really, I spend a lot of time talking to loan officers about how to close more transactions. I travel the country, having lots of conversations about how people are growing their business in a market that's flat to down. So that's really where I spend most of my time. Here at Newfi, that's all we do is non-agency business. We're owned by a private equity firm, the world's third largest private equity firm. And if you look at the private capital space, we've really kind of stepped into an important role in the non-agency space these days, and we're excited about the future. So great to be with you, man.
Yeah, well, thank you for sharing that with us, and it's nice to know who we work with, right? And who's leading the charge at these lender partners.
Yeah.
So for those newer to maybe the non QM space, what is non QM really, and how is it different from the old subprime world, right? So for you guys that don't know what subprime was, this was like prior to
Mhm.
2008. We lived in a world where there was an implode meter online, and we would follow it daily to see who was closing down. But how has the non QM market evolved since this comeback?
Yeah. Yeah. I mean, it certainly has always been an important conversation in the evolution of the non-QM business. You think about kind of when it started was back in 2013 when Dodd-Frank happened, and we created this idea of a loan that fit the agency box, and those were qualified mortgages. And what non-QM theoretically did was do mortgages that were non-qualified mortgages that we still felt like met the ability to repay. And so the cool thing about the space today is that we've had a decade to really prove it out, and we've had some good times. The first 5, 6, 7 years of the non-QM business was really pretty small, and during the time that was growing, the economy was solid. Jobs were growing, values were going up, kind of across the country. So we had the wind at our back, if you will, um, and the loans performed. You look at the performance today and during those first 6, 7 years, really performed about as well as an agency loan did. And so if you think about the difference between where we are today versus kind of pre-crash, I think there's an important look at what subprime was in 2000. say 2004, 2005, 2006. We got, those were crazy days. Those were days where we were doing loans that were no skin in the game. Credit didn't really matter that much. We were doing low credit scores. But the biggest issue was there was no skin in the game. We were doing a lot of 100% LTV loans where nobody had anything invested in the transaction. That was a huge problem. But if you go back to 2003, I would say probably the 2003 back to about kind of the late 90s when the subprime business really started to evolve. If you look at the securitization market for those transactions up until about 2003, those loans are still performing very, very well. And those loans had skin in the game. It wasn't until 2004, 2005, where we really started to push the credit box to a place where we probably we know now we shouldn't have, because those loans under pressure didn't perform. And so the great thing about non-QM is that you have skin in the game, you have ability to repay, you've got in some sort of income documentation proving out the transaction. And the thing that's been fascinating about it, KT, is that these loans are still paying. And it's had stress, a lot of stress. So if you go back to COVID, everybody said, well, it's had no pressure. It's had no pressure, the wind at your back, like everything's working in your favor. So you don't really know how these loans are going to perform. Well, then all of a sudden we had the whole world shut down, right? And one of the biggest impacts was on self-employed borrowers. All these self-employed businesses had to shut down or figure out some other way to generate revenue. And that's exactly what happened. So up until that point, most of the business was really bank statement loans. And one of the things that you could see with these businesses was you could look at their bank statements and you could go, okay, all the way up until February, you could see the revenue coming in, and then all of a sudden COVID hit in March and the income dropped like a rock. And then a couple months later, you start to see income climb again, gross income climb again, revenue start to climb again. And these businesses figured it out. And that's just one example where we think that we really proved out the concept of the non-agency business. It's obviously become a lot more than just bank statement loans these days. But that's been the real driver of the business.
Yeah, I couldn't agree more. When we talk about subprime and really what it was, and it was so far to the left, I mean, just worlds away from where it is now. It has
Right.
kind of come back to the center over the years. And even in the last 2 years, I feel like it's come a little bit even more where it's not subprime, but it's not a paper business, right? But it's like it's like right outside the box of that, almost like non-traditional
Yeah.
loans, even, almost there, but not quite ready, type of
Right.
loans. And it's
Right.
just a substantial difference because you're right. It's like, especially for those originators that weren't in the business then. I mean, literally, if you had a pulse and a social security number
Yeah.
and a decent, even not even a great score, just an okay score, you were getting 100% loans, and it's easy to walk away from that stuff if something
Yeah.
goes bad.
Yeah. It's tough for me to watch The Big Short, KT.
Oh, me too, because it's not it's not
Yeah.
entirely. It's more accurate, but it just puts brokers in a light that isn't positive, and unfortunately was
Yeah.
not the reality entirely. I mean, that was probably not a fair depiction. But hey, it's Hollywood. We believe everything we watch, right? But,
That's right. Yeah, that's right. Yeah.
so what do you think the biggest myths or misconceptions that brokers still have about the non-QM business
Mm,
side of the business?
mm. Yeah. Yeah. I mean, I think there's a lot of loan officers that do still think about it as a subprime loan. But I think the biggest challenge that we run into is people think it's hard. And that's probably the largest misconception. People are just afraid of it. They don't really know. And really, when you get done with figuring out income, the rest of the transaction looks exactly like a conventional loan. And we just look at income differently. Matter of fact, one of the things I tell loan officers all the time when they're thinking about, as you've grown up in the business, we've all been taught you need to look at adjusted gross income, right? So you go to the bottom line of that tax return, right? And you see adjusted gross income. And if it's a low number, you start, oh, okay, well, there's no way this person's going to qualify. I can't help them get a loan. Like you're going to have to figure out another way. Well, what we teach loan officers is you really need to go to the top line. You really need to go to that top line of revenue and figure out whether or not where that money's coming. Because there's a lot of times businesses create a lot of revenue, call it $1 million a year of revenue, but they do everything they can to drive down that tax fee, that tax bill, and as they should, they're doing everything they can to drive that down. There's another way to get that transaction closed, and I think the best non QM companies today are really looking for good creative solutions to these problems. And sometimes it's bank statement loans, sometimes it's something else. And the best companies are the ones that are actually working with those loan officers right up front to try and solve those problems. Because KT, when that borrower walks into your office and they're like, there's a story with every loan. Every borrower is unique, and they don't always fit into that agency box. And when they don't, I think the biggest challenge that loan officers face, and look, I think there used to be 3 different types of loan officers. One was, I don't do non-QM. Like we would get kicked out of offices. Like we'd show up and KT, you say to us, I do FHA and VA. I don't do these non-QM loans. Okay. I'm not saying you did, but
Right.
we have loan officers that would say, I just don't do them. And we'd say, okay, that's fine. We'll go find somebody else. The second one is loan officers who use it for fallout. So they're open to it. They have a transaction, they have a borrower, they can't get them done agency, but I'm going to call that non-QM guy and see if he can get that a deal done. And then we have a conversation. The third one, and really where we drive most of our volume, is people that are actually talking about non-QM in their outbound. So it doesn't matter whether or not social media, or it's a newsletter, or it's an email campaign, past clients. It doesn't. You're doing your own referral networks. It doesn't matter. You're out there talking about non-QM, and we think that loan officer today is actually growing their business more than other loan officers that are just talking about conventional transactions. Because the other misconception is that people that are selling non-QM retail are just getting non-QM business. We think if you're out there talking about solving problems for borrowers, you're going to grow your conventional business as well. Like this is part.
Yeah, I've got some crazy stories around the ability to get some non-QM loans originated and closed. And the one that comes to my mind always first is a famous YouTuber in Longview, Texas, of all places, John.
Yeah.
And he did not even file tax returns for 2 years. Right. So we had to, obviously have a CPA look at him and get a letter and do all the things that we needed to do. But he went to 5 lenders. He went to a couple of banks. He went to a couple of retail lenders. And what was interesting is when I finally got to talk to the guy, he had given up all hope. And I had mentioned a bank statement loan. He said, no, man, I already did that. And I said, well, with who? And he named the company, and it was a retail lender. And I said, oh yeah, bro, like not all bank statement loans are created equal. Let me be very clear about that. And I did some explanation around that. And I think you could definitely comment on that. So there's 2 questions I want to ask here. The first one would be, who is the real borrower inside of an originator's community? Who's the real borrowers that they're going to be able to help and can serve from a non-QM perspective, right? And explain a little bit about why you think that not all bank statement loans or non-QM loans are equal.
Yeah. No, it's great. So every loan we do has a story. They get, there's a lot of non-QM loans that fit the box, and we don't have to have a lot of dialogue about it. And it's a self-employed borrower, and they have bank statements, and they qualify, and you move forward and you close the loans. And we're here at Newfi. We close in about 18 days or less. From submission to CTC. So some of them are really easy, but they all have some sort of challenge that you have to deal with. And so look, everybody does non-QM these days, right? I think there's only maybe one or two big companies that are doing non-QM business on a wholesale basis in the country. It's very few. So you can get these loans done now pretty much anywhere. And if you are a cookie cutter non-QM self-employed borrower, then you could probably get it done anywhere. But that's the challenge becomes when it's not cookie cutter.
Well, and I think what I think the question, to be more specific, is a lot of retail are getting into some non-QM space as well. And from my experience, they haven't always been the same. They've been substantially more strict than what you guys on the wholesale side provide, for us to be able to serve the marketplace with.
Yeah.
I don't know if that's been your experience or not, but.
Well, so if you look at the process of originating and closing a non-QM loan, the real question is what happens after you close. And so after you close, there's two real exit strategies for this non-QM loan. It used to be back, kind of before COVID, it used to be that the only exit from a non-QM loan was to securitize it. That was the only way to exit from the transaction. And that's why the number of people that were originating non-QM loans was very small, because a lot of wholesalers didn't want to take this risk of putting it on their balance, putting it on a warehouse line and trying to figure out a way to sell it. It was very, very challenging. So the number of people that were doing it was very small, and the ones that were doing it were pretty good at it. And so if you look today, one of the reasons why the market has grown so much is because there's another exit, and that is the insurance company exit. So we're owned by a company called Apollo. They have a company called Athene, which is an insurance-based annuity company. And about 75% of what we originate goes on the insurance company balance sheet. So that doesn't mean a lot to an originator. Maybe it doesn't mean a lot to the borrower. But what it means to us is it gives us the flexibility to say, these are our guidelines, but we can still see this ability to repay in ways that others can't, because we're looking at so many transactions every single day that we have the ability to say, well, we've seen that before. We've seen this borrower who has 3 or 4 different businesses, and the income flows different ways for each business. And we can see those. Some companies can't figure that piece out. And so as a loan officer today, as a broker today, if you have a way to see that income happening in their business, that's really the first question that you have to ask. Is you have this business or these businesses, where does the money flow? How does it flow through your bank statements? Would you have multiple bank statements? Is it one bank statement? Is it 2? These are the kinds of questions that you have to start asking. And within that, you understand the story of the business. And so they are definitely not the same. And I think the other thing, we've been talking a lot, KT, about self-employed borrowers, but one of the big pushes, there's 2 big pushes really in the non-QM space where we're seeing growth. And the second one is in the investor space. So the growth of the DSCR volume as part of the non-QM space has been dramatic, and we've seen an almost doubling of the business because of it. And so it's not just self-employed borrowers, but investors, people with assets that don't have a lot of income. It's kind of the third category. You might be surprised to know that about a third of our business is full doc non-QM loans. So these are borrowers that just don't qualify for whatever reason on the agency full doc program. Maybe it's credit, maybe it's assets, maybe their DTI doesn't. There's all sorts of reasons why people go this route. But we've seen a big jump in our full doc non-QM business as well.
That's awesome, dude. That answer was pretty high level. I appreciate you explaining it from your perspective and how you guys review the income and asking that question, even for ourselves as brokers, is, well, how does the income flow? How does it flow?
That's
And
right.
if I know that Newfi understands how income flows and you're studying that, and that really is what, what you feel is, separates you guys from maybe other non-QM products that are out there, or the investors that serve those up, that you guys are just more open to studying that at a level that's going to give you data to maybe get other loans done that some wouldn't do. And so that's good information to have. I've never heard it explained like that. And I was like, wow, I was memorized here, man, just by like the way you were saying. Is like, dude, this is the kind of intel I like to have. So let me ask this. I know you did talk about the growth in the non-QM, why it's growing so fast. What do you think the market share is now today? And what does the growth look like moving forward? Because from today growing forward, like how much opportunities available for us on the
Yeah.
books?
Yeah, it's significant. So one of the things that we said while we were at Fuse was the companies that are the loan officers that represent the companies that they work for. Those companies have closed just with Newfi about $500 million worth of non-QM business this year.
Wow.
So if you take that and you take kind of the average comp for loan officers in those transactions, you're talking about $10 million worth of commissionable income. This is just from the companies that were represented at Fuse. If you go larger than that, we think that the market, and then by the way, just so you know, like this is a guess. When you close a non-QM loan, if you go to any of the data providers, Modex, MMI, Surge 360, Redder, all these companies that track production, all our loans show up as conventional loans. So when you look at the numbers, it's really hard to determine the actual volume. So there's two ways to do it. The first way is you can look at the securitization market, because as I said, most of the exit from a non-QM loan is through a securitization. So that gives you a sense, gives you kind of a baseline. And then what we do is we extrapolate what we think the insurance company purchases represent in the market. And we think it's about double. So you take the securitization market, times it by 2, and we think that's about your total volume. So if you look at those numbers, the projection for 2025 currently is about $125 billion worth of non-QM production. And that's up from probably a little over 80 billion in 2024. And we think it will grow in 2026. And there's a lot of reasons for it. Certainly the evolution of it, the loans are paying. We are now part of the lexicon of the mortgage business. So back in the old days when people would kick us out of their office and say, I don't do non-QM, there's very few of those loan officers today. And so if you have borrowers now, even if refis pick up, we think now these loan officers will be able to say to us, I have this system and this process of refi, and I'm busy and it's good and my business is picking up, but I don't want to turn this borrower away again. Because the other piece that I think is really important, KT, to talk about is the job of a loan officer is changing. We are in the middle of an AI revolution. There is no question about it. You spent a lot of time talking about it last week in Nashville. A lot of people did. And while it hasn't invaded the mortgage business quite yet, I do believe that standard borrower, that W-2 good credit score standard borrower, if you don't think the AI is going to figure out a way to close those deals around you, you're wrong. Yeah, I believe that completely. And so, and then if you combine that with the other forces that brokers are working against, banks and credit unions, servicing companies, all of these people are trying to get to the borrower before you do. They are all trying to figure out a way to do it. And so we have to be better. As a wholesale lender, we have to be better. As a broker, I think you have to be better. We have to all figure out a way to be better. And one of the ways to do that is through conversation. So I actually believe that with this AI revolution is going to come a counter revolution. And that counter revolution is going to be one of connection. I think people are like, we've gone through a couple decades now of technology evolution. And I think the world is ready for a time of more connection. And it's within that connection, within that dialogue, that you find ways to create value for your clients. And so I think that's the most important part of this whole non-QM piece, because that's all we do. Every loan starts with a call, starts with a dialogue with you and one of our account execs. Hey, I got this borrower. Can you do this deal? It's still, and we think that will continue.
Man, you're blowing my mind right now. We're gonna have to do another podcast. First of all, that's let me go and put that out there. I love the information you're giving me. You've got my wheels spinning, John. You really do. Like, I'm sitting here thinking, man, it's so easy to know what the big four are. It's conventional, it's FHA, VA, USDA, and we always think of that in that way. And we need to add a fifth one, and it needs to be non-QM. It's that big. But the way you explained it, just from a education piece, right? And getting the word out there. I think you're right. I don't think that we have done a good enough job. I know I haven't. I'm sitting here thinking, and one of the questions was what is, what's a mistake that originator makes around non-QM? And I think you answered it in that last bit you gave us, is we're not having enough conversations. We're probably not educating the consumers. And you got to education. I always believe you have to, when we're educating our local communities and people, that are out there that we serve, you got to proof it. You got to like walk them through and say, this, John did this, or in my case, it was a client who went to went to a couple of banks, went to a couple of retail lenders, and then came to me, and I was able to get them done. And it was a non-QM loan, because a lot of consumers don't know what non-qualified mortgages even mean. And I think you're right. I think that we can definitely do a better job as an origination force to get that word.
Yeah, but KT, I love your story, because your story about this YouTuber, I mean, this is the essence of why we do what we do. I mean, that borrower, I don't even know 5 years ago that borrower wouldn't have got financing. 10 years ago, for sure they wouldn't.
Yep.
And so this is the essence of what we do. I mean, like I said, I've been doing this for a very long time. And I said the other day, the one thing that AI can't do is it can't feel. And your borrower, your YouTuber will always remember you.
Yeah.
Because you solved that problem. And you will always remember the YouTuber because you solved that problem. Like, there's a lot of borrowers that are sitting in a 2.5%, 3% mortgage. Maybe they don't remember who their loan officer was, because it was just another rate. They were at 4 before, and now they're at 3.5, and then they went to 3. And it's about the number. It's not about the solution. And that's what I think. And I think the biggest mistake people make is they just don't talk about it enough. So,
yeah, I agree. Man, my wheels are spinning, and I've got so many questions for you, and I know we're limited somewhat on time. I try to keep these under 30 minutes if I can. Let me ask you this, and this may throw you for a loop. I don't know why I'm asking it this way, but if non-QM were a vehicle, what type of vehicle do you think it would be? It seems like it's just different, man. It's like, it's not a traditional way of doing business. And, I'm looking for an analogy here. Like, how do we explain that? How do we explain that to loan officers, man? I think it's like a garbage truck.
This isn't going to probably sound right, but it's like a garbage truck. Like, it picks up all the trash, all the stuff that the loan officer is, I can't do that loan. Oh, there's no way that borrower is going to qualify. Throw that one in the trash. Like, but then we take it and we shine it up and resell
Yeah.
it, and it comes out looking pretty. I mean, so I don't
Yeah.
know. Garbage truck probably is a garbage truck going in, but it's certainly not looking like that going out.
Yeah. Well, I was thinking like a cyber truck only because they're kind of ugly, right? But
Okay.
they're really not, you know? Like, they're
Yeah.
really not. So,
Yeah.
they're pretty sweet, but to your point, yeah, it's things that we traditionally don't think that we can get done, that we can get done. And, it's really the last year and a half or so, that's been kind of the theme in my office as well. It's like, "Hey, we can't do this one traditional." And I don't even have to say it anymore. The team already knows, okay, now we're looking at non-QM products. Let's shoot it out to our people and see if it's something
Yeah.
that we can do. And hey, man, I'm not blowing smoke up your backside, John. I bet our business is 30%
Yeah.
non-QM right now, which is wild to me.
Yeah.
Which is another, that kind of brings up another question I'd ask you in
Yeah.
closing here is, do you think non-QM, at least I feel like this. I want to know what you think. Do you think it can recession proof a loan officer's business?
Oh, I think we're in the middle of proving that right now.
Yeah.
I mean, we know it can. Um, the loan officers that we do business with that focus on non-QM for non-QM sake, their business is thriving. Is absolutely thriving. I have a good friend of mine down in Orange County. He's been focusing on this for over a decade, and he himself closed $30 million last month.
Wow.
There's another. I had dinner with one of our top clients a couple weeks ago, and his business is thriving. He's focusing on DSCR. The other guy down in Orange County focuses mostly on bank statement loans. But the person had dinner with the other night was DSCR focused, and his business is thriving. And so I mean, look, I mean, the market share for non-QM probably is for the year is going to probably be in the 7 to 8% range, but it's growing. There was a report by Optimal Blue, Totality. I can't remember who it was. They said their locked pipeline it was up to almost 20% of their locked pipeline was non-QM focused.
Wow.
And then, I mean, I don't, I don't typically spend a lot of time talking about Newfi on these things, but one of the other things that I think is important, one of the reasons certainly why we have been growing is because our service levels are just off the charts. So because we are so focused on this initial conversation with the broker on what that borrower is, what they represent, can we get a transaction done? Our account execs do an amazing job of deciphering that transaction right up front, so they know whether or not there's a possibility that deal is going to close. And we do this thing called NPS scoring, Net Promoter Score. Every transaction we close, we go back to the loan officer, and matter of fact, I just saw one today for October, so we're almost a couple days left in October, and our NPS score was above 85. And if you chat GPT 85 NPS score in a mortgage business, it's off the charts high. The average is somewhere around 40 to 50. And so that's really, if you're a loan officer today, if you're a broker today, you're thinking about originating, don't be afraid. Like, come on in, the water's fine. We're going to treat you with kid gloves. It's your first one. And if it's not, then even better.
And I can contest to this. I've closed some loans with you guys, and Michelle McBride is my AE over there. I've known her for over 20 years or close to 20 years, and she's one of the best in the business. And I know you guys care at a level that's rare because, again, when you're dealing with non-QM, traditionally, they got hair around them. They're really hard to get closed with some non-QM lenders. I'm just being honest about it. But you guys have made it easy. I think, to your point, a lot of people are making it easier, and it's becoming more of the norm. And we as originators need to do a better job of promoting that in our communities and making that, a better part of our business. Now,
Yeah.
that said, I got one more question. I know I said I had one more, but I really do. I always ask this question. I ask it on every episode of the Loan
Yeah.
Officer Experience podcast. And it's this: there's a lot of retail lenders that are out there. And I don't bash retail. I love retail. I lived in that space for a little over 9 years. But being back on the broker side, things have changed. You know, I feel like technology's really leveled the playing field. I feel like a customer again. I feel like I have more options. All of these things that KT believes make us diversified better in some cases, you know.
Yeah.
What would you tell? Because I have a lot of retail friends and they're always asking me, KT, how is it? You know, and I give them the pros and the cons.
Yeah.
But what would you tell a retail originator who's considering coming to the broker side? What advice would you give them?
Yeah, I mean, there are plenty of great retail companies that do a great job. But the thing that I have always loved about the broker space, and by the way, I mean, of the 37 years I've been doing this, most of it is on the wholesale side of the business. So most of my experience is working with mortgage brokers. And so every once in a while I get the opportunity to be in front of them, and I will tell you this, I love you. Because I have built my life literally around serving mortgage brokers. And when you succeed, I succeed. And so if you're thinking about making that transition, really the number one thing that comes to my mind is optionality. So we're really good at what we do. We're one of the top non-QM lenders in the country. We don't do every loan. I mean, we have the capacity to do every loan, but we choose not to. So there are other wholesalers that will do loans that we won't do. And we love that. I'm happy. Matter of fact, one of the things we tell our account execs all the time is make sure you know what your competitors can do that we can't. So that when you run into a transaction and you have a broker come to you and say, hey, I've got this borrower, can you solve this problem? If our answer is no, but you know somebody else who can, then you should be telling them. And that creates value in that relationship.
Yeah, I love
and
that.
so the greatest thing about mortgage brokers is they get this ability that a lot of retail companies don't have, which is if I can't do it in-house, I'm dead. And as a mortgage broker, if Newfi can't do that loan, there's 5 other companies that you can call that may have the opportunity to do it. And that optionality saves transactions. And in this environment where we're in today, you don't want to lose a loan. You don't want to lose that borrower, because the minute you lose that borrower, you lose the referral source too.
Absolutely.
And
well,
anyway,
John, yeah, that answer, that response in itself tells me everything that I need to know about you, Newfi Wholesale, because if you don't have that scarcity mentality and you're willing to lead your people to refer it to other people, it just says a lot about who you are. So if you're listening to this and you heard that, that's the type of people that I want to work with and partner with and put in my tool belt as lender partners. So John, thank you for your time. Thank you for your experience. I want to do this again, dude. This is awesome. You're just a lot of knowledge, man. I want to like kind of pick your brain a little bit more. I know it seems weird, but it's like I want to consume more of what you shared today and really get educated and educate our people. But
next time we can talk about man in the arena.
There you go. There you go. I love it. I love it. All right, my man. Thank you so much. And
Thanks,
we appreciate you so much.
Appreciate you.